Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name's Corey Kramer and today we're going to take a break from analyzing individual stocks and talk about the 3 steps Wall Street uses to take your money as an individual or retail investor. I made a video about kind of the first lesson of investing from an individual investor standpoint, and that's to treat your stock investments as a partial ownership of a business and some of the implications of that in my last video. In this one, I think it's important to kind of invert our thinking about how to make money in the stock market and think about how to not lose money in the stock market. Very Charlie Munger approach. And it's best to zoom out and understand the process that Wall Street and the financial media have to basically take your money as an individual investor. So it goes like this. The first step is usually the way that people get introduced into individual stock investing, maybe not like so much a 401k or something like that, is with the idea that you can get rich quickly investing in stocks, and that it's easy to invest in stocks. And usually that takes the form of things like IPOs, SPACs, fads, new technology. Those are kind of the big categories that get pushed out there for newer investors and those who want a way to get rich pretty quickly via the stock market. And really what those are a way, and since we just had one of these, and we're still in the process of it to some degree, but since we just had a big IPO and SPAC bubble, boom, whatever you want to call it, I think a lot of people will be able to relate to this. But when I first started investing in around the year 2000 or so, I experienced this when I was back in college and invested for the first time as well. Really, it's to reach out to new money and to sell shares of these newer businesses, not just the IPO, but within the first 2 years of the IPO, maybe 3 years, insiders who started the business or who funded the business or helped bring the business public, they're selling their shares to the public, and they want to get the best price they possibly can. So they're selling part of their business, maybe sometimes the whole thing, to the public. And so the whole system is designed to get the best price for them and not the best price for the people that are buying the stocks. It's very rare for a stock to IPO and never trade below that price again. And then, I mean, we're talking 1% of stocks maybe. Unless they have their IPO during a recession, it's almost guaranteed you can buy it at a cheaper price a few years down the road. Usually a much cheaper price, 80% lower, 90% lower, and then a lot of them will fail. So they're really mostly just a way to take investors' money who are trying to get rich, who are getting in on the hype, and you should avoid those at all costs, basically. I don't invest in companies until at least 2 years after they're public. Really, it's even pretty rare for me to invest like 3 years. You know, that's 1 or 2 I might pick up if they've fallen already and look like they're still good businesses. Now, the positive side of IPOs and the fads and everything else is it does spark innovation in the economy, because people who are trying to invent new things, some of them are actually useful. Some of those businesses do actually need more money to fund their enterprises, and the enticement of being able to cash out some of your shares can push people to take risks that they might not otherwise take, and the public can ultimately benefit from that. But my advice is you don't want to be the sucker that's funding that. So let somebody else be the sucker for that. Okay, so a lot of times people first experience buying individual stocks is they lose money. That was definitely my first experience, and I think a lot of people the past couple of years are probably getting a taste of that right now. So that kind of primes everybody for the next couple stages here. The next step is there's a whole financial of the way that Wall Street is going to take your money. Is there's a whole financial media industry that's designed to focus people on 1 year or less time frame. We talked about in the last video in this series where you're buying part of a business. Well, you're buying the future earnings of a business, usually anywhere between 10 to 20 years into the future. It's going to take you to earn your money back from the earnings of that business, what you invested in it. So what happens in 1 year is not going to necessarily determine the outcome 10 years from now. And more importantly, well, let's put it this way. The correlation between stock price and earnings, it grows over time. So there can be very low correlations on any given day, month, even year between earnings and the stock price. But when you go out 10 years, the earnings, whatever happens with earnings, is probably going to be roughly what happens to the stock price. That correlation increases more over time. The difficulty is it's harder to predict earnings over time. So businesses fail, competition comes up, consumer tastes change. So knowing what a business is going to earn in 20 years is pretty difficult too. However, the trick that the financial media and Wall Street basically do is the 1 year stock price of any given stock is pretty much completely unpredictable. So there's a whole industry designed to predict stock prices in the next year. Pick your short time frame to long. Year is kind of the maximum. Like 2 years is really the maximum, but really it's mostly within a year. And those are unpredictable. So none of these people know what they're doing. I mean, numerous studies have shown all these analysts. I mean, why do they have sell-side analysts telling people for free what they think a stock is going to do, right? It's because they're just trying to create churn in the market, to make people think it's possible to predict stock price movements in a year when it's totally impossible, pretty much. And certainly individual investors are not going to be able to predict stock prices within a year's time frame because the correlation between earnings and free cash flow or whatever else you want to use doesn't really get tight until several years down the road, okay? So the entire thing is like a useless cause, but everybody's made to believe it's not. Like nobody's, well, the smart people do. I mean, Warren Buffett, Howard Marks, I mean, Ray Dalio. I think they would all say that nobody can predict what the stock market's going to do in the next 3 months or 6 months, or individual stock is going to do in the next 3 months or 6 months. I mean, but none of that makes the news very often, you know. I mean, you get the answers very dissatisfying as a viewer or a reader that, oh, well, they don't know exactly what's the forecasts are going to be. And then they move on to somebody who is going to tell you what it's going to, and they'll be wrong 50% of the time, and they'll be right 50% of the time. But the whole idea is to create this notion that anybody knows what the stock price is going to do in a year. And what it does is it creates churn in the market, which creates money for people. It allows the traders at these places to make money off people that don't know what they're doing, reacting to short-term kind of emotions and all kinds of things like that. But it really just creates a general sense of chaos after a while to somebody who's trying to do this, because ultimately they'll fail or get really lucky or unlucky. I mean, if you're running a super concentrated portfolio, you can get lucky on something big, and then, you know. But if you take enough rounds and you focus on the short term, you're not going to come out ahead as an individual investor. So what can you do, right? Well, to me, what I would say is, I mean, everybody can have their own approach to investing, right? But if you focus on the 5-year time frame, that can really help. It can be a rational way to do it, and here's why. Usually most stocks prices adjust to any kind of irrational pricing or within 2 or 3 years. Most of the time, that's enough time for the market to kind of catch on to whatever it is that got wrong and correct it. Unless there's a recession, and then that could push that out to like 5 years. And that, it could be longer. So if you are able to predict roughly 10 years into the future, which is what I do, which is kind of the maximum I think most people can consistently get right, like 80% of the time maybe, then if you're going to sell after 5 years to somebody, you should assume that they're going to be doing the same thing if they're rational, and they're going to be looking another 10 years into the future and saying, okay, this is a good deal for me now because I can, So if you're selling, you're not always selling to rational people, but at least it makes sense in a market where your time frame can be different than the market's or anybody else's, and maybe they're just looking at a different time frame. They're looking at that short time frame everybody else is. So to me, if you can predict earnings 10 years in the future, then you probably can get the stock price roughly right 5 years in the future. And that 5-year mark is a pretty good judgment. If there's no recession or anything, honestly, I mean, most stocks, like 80 or 90%, will get more rational if they're underpriced or whatever within like 3 years. That's been my experience. And I think Greenblatt said that as well. But not a year, not 3 months. I mean, it's just everything. I do this every day, so I see it every day. If I was to just write down the time frame that a person or a media person is focused on, it's never more than a year, almost never. Okay? So, and it's all worthless, pretty much, if you are looking past that. So Wall Street they suck people in. First, they take their money because they're greedy. The next step is to create chaos. So people are like, who knows? Like, anything could go wrong. And then you do have recessions. You do have depressions. You do have lost decades in the market. So these dangers are really there. It seems totally chaotic. But at the same time, unless you want to live on your wages, a person's in a wage economy for the most part, unless you wanted to be dependent on that or be dependent on the government to give you some kind of pension or something, you need to kind of invest in the stock market in order to get any kind of independence. So this creates a situation where, okay, you have this chaotic market, but you have to really kind of invest in it to some degree, or you have to invest in something anyway. And so then Wall Street comes along with the number one way that they take your money is they tie safety or risk. They tie risk to volatility. So the financial media creates the volatility in the traders and everything that work at the investment banks. And you have all this volatility, you have all this chaos, and then they say, well, we can sell you lower volatility and that's safer, right? And that's where they really, really, really make their money. It's all about selling safety, usually in like bonds or alternative assets, diversification of various sorts into poorer businesses, but they're different in some other part of the country or something, or real estate or whatever. Areas that it's harder for individuals to access. Now it's going to be like private equity and, all that kind of stuff. Whatever they can sell you to make you more diversified, safe, and less volatile, that's where the big money is, right? And once people have been primed by first losing out on being greedy and then losing out by trying to predict what a stock price is going to do in the first year, they're pretty well primed when they get close to retirement and don't want to be pushing the carts in the Walmart parking lot to make an extra dollar as this radio ad I sometimes hear says. They want safety, right? So everybody's there to sell safety, and the number one way to sell it, and it's most, I don't know, it will be the most popular because people don't know how to invest anyway at all. The rest of the people don't even try, right? They just get their target date funds, which is what I'm going to talk about here, at work or whatever. They don't really understand anything about them. It's just like now they're automatically enrolling people in them so that they can get those fees, you know, without people even realizing it. But the key to all this is education, which is one of the reasons why I do what I do. And I don't even really think I'm an expert, you know, in most of the things. I'm mostly an expert in, you know, recognizing the things that don't work very well than I am explaining the details of the things that do work very well. But, so let's look at a target date fund. This is a fund where you put your money in, you tell them the date you want to retire. They manage the risk as you move through time into retirement. And we'll see what's happened the past 4 years with Vanguard's retirement target date fund 2020. So you retire in 2020. That's what this goes back to. This little yellow amber line, whatever you want to call it here, this shows the inflation adjusted. You can see I have the inflation adjusted returns of this target date fund for the past 4 years. Okay, so you retired, you're 4 years into retirement, and here's how you're doing right now. Let's go up here. You are negative inflation adjusted minus 0.49% because this is sold as being safe to people. You don't want the well, it hasn't even been during 2020, during the March decline, it was less volatile. So that's your plus here. You didn't fall down to what this is. The red line is the equal weighted S&P 500. You missed out on this volatility, so that created your safety, okay? And in exchange for your safety, quote unquote, you lose money. This is no withdrawals, okay? This is not anybody taking their money out. So I should probably set it up for that. But so you imagine just taking 4% a year, so you're taking in another 16 to 20% out, and you're down. You know, your retirement fund is probably down 20% in real terms in 4 years, right? That's their safe alternative. That's the safety that you get by not understanding anything about investing. The other blue line that I have here is just a standard 60-40 fund, basically a balanced fund from Vanguard. And this one, inflation adjusted, has a 2% CAGR over 4 years. But that's for people who aren't retired, right? That's if maybe you're getting like close to retirement or you're worried about risk. You want to manage that risk. Well, managing the risk has gotten you almost no returns. And then I put the equal weighted S&P 500 to get rid of the Magnificent Seven and all that stuff. So this is just an equal weighting of all 500. But if you invested in stocks, that's a 5.2% inflation adjusted CAGR is pretty good. Usually 6% is kind of where you want to be, but we had this bout of inflation. Well, you want to be more. I aim for 8% plus inflation, but 6% is pretty decent, right? You could definitely build a retirement program on that, because businesses can pass, if it's a good businesses, which most of the companies in the S&P 500 are, they can pass ultimately this inflation on. And so you lose money when you buy safety because it's not really safe. You can see from that target date fund, and please note, I did not pick the worst date to start this. The worst is 2021 because you'd be toast, absolutely toast, if you started in January 2021. It's even worse, and people that have these funds probably know that now. So that's probably why everybody's upset about the economy, even though the economy's been pretty fine, because they got suckered into, because really what they're doing is they're loaning people money at fixed rates and businesses and the government on bonds, while inflation is going up and eating away the money, and there's no way these bonds are going to do anything. Like, they're not going to protect them. They're just going to be losses. They're just loaning money to people that aren't going to pay it back with dollars that are the same amount as being lent at. And anybody who looked at the interest rates that they were getting for these bonds should have known that it's a bubble. I mean, it was a huge bubble, way bigger than any stock market bubble. And the idea is to slowly manage this so that it slowly eats people's money away safely, until they realize kind of what's going on. So those are the three ways, and there's all different kinds of other ways that Wall Street will sell safety. Options. I mean, there's a billion ways that they've invented to basically sell you safety, when really what you want, your safety is a quality business at a decent price. So 3 steps, think about them, understand that volatility isn't risk, understand you're not going to get rich quickly in the stock market, understand that all the financial media that's focused on things less than 1 year is complete gibberish. And I have to do it sometimes because that's just the only way you can communicate with people. But I always try to stay focused on if you watch any of my analysis, I'm looking at 10-year things, and I'm kind of usually bringing them back to like 5 years. So those are the basic ways that you can try to avoid. And the number one way to avoid it is just to learn about investing, and then to learn about the businesses, if you can, and what you think you should be, what you're willing to pay for a piece of that business, over the, just say 10 years, 5 years, or 10 years. Because you don't have to, it's hard to look out 30 years, but if you can kind of get that 5 to 10 year range, you'll do pretty good. And you won't be one of these people in this target date fund that retired and their retirement portfolio is lost 30% or 20%. Okay, if you enjoyed this, hit the subscribe button. I usually do individual stock analysis, but lately I've been sprinkling in a couple of these bigger picture investing videos, and people seem to like them. So if you have any questions, put them in the comments and I'll answer them. If you have any stocks you'd like me to take a look at, put those down there too, and I'll do an analysis on them. All right, thanks a lot. See everybody later.